And today's our topic is underwriting multifamily value add deals in current market. Uh, and disclaimer: this webinar is only for education purpose only. Uh, and you're free to accept or reject any or all the investment recommendations made by me. All services that we offer are subject to market risk and may result in loss to your investment. Please consult a professional advisor before investing. This is standard disclaimer. So what we'll be covering in today's session, so mainly gaining understanding of what makes a good deal through underwriting strategies. And please type what is good deal for you in this current market. We can have that discussion in this session. And understand the value of rent roll and T12. What do you get from rent roll and T12, and what you need to analyze, and what kind of financing options available in this current market, agency versus bridge loans, and also we'll dig a little bit deep into rent projections, how exactly we can see the rent projections, how to get rent projections, uh, those kind of stuff. Then also we'll go through some loan to value, capital reserves, real estate taxes, insurance, DSCR, etc. When we underwriting, why we need to understand all these parameters, and also reversion cap rate. So, and what is good cash and cash, and also IRR, AR in this current market. And feel free to type, your questions, and also your thoughts on what is good deal for you in this current market. And before going into topic a little bit more about myself, I'm founder of Usha Investment Group. I'm out of Greensboro, North Carolina. So mainly we focus on multifamily value add deals in North Carolina markets, Raleigh, Charlotte, and Greensboro. These markets we are focusing. Also South Carolina, Greenville, or Spartanburg markets. I'm also host of Multifamily AP360 virtual conference, and also host of Multifamily AP360 podcast. Also author of book called Creating Wealth Through Passive Apartment Investing, mainly for passive investors. So we mainly focus on value add apartments, and even this webinar is mainly focusing on value add apartments. We are not focusing on any new construction or new development or any distressed properties. Okay, we completely focus on value add deals and value add apartments. What exactly value add apartment means? Occupancy is 85%, and also we focus on minor or lighter operations like interiors or exterior renovations, and any management issues or some parking, fixing some parking lot issues, anything like that. So please type what is good deal to you. Or you can type now from cash flow point of view, or from IRR or ARR. In this current market, definitely 5 to 8 or 5 to 7% is definitely cash and cash point of view is there. We can expect 5 to 8% cash and cash, and IRR also maybe around 13 to 17 or 13 to 18 or 30 to 20 is definitely reasonable or good deal, and it should generate cash flow during downtown or tough market conditions, and it should be under good market, good sub-market, neighborhood. These are some parameters. What else? for you, according to you. Good deal. So, and what you get from, rent roll or T12. Let me share another my underwriting model. I will go over some of these parameters. So Kim said 8 plus cash on cash 8%. Okay. Uh, that is one of the underwriting model I'm using, and let me go over rent roll. What you will get. So rent roll basically will get number of units, unit number, and unit makes like 1 bedroom, 1 bath, or 2 bedroom, 2 bath, or 3 bedroom, 2 bath, or something like that. Unit makes, then unit size, lease start date, lease end date, and the residence name. What is effective rents, and market rents, and effective rents, mainly effective rents. So mainly we will see this in under rent roll. Then we can customize this underwriting, and we can get some leasing trends, and also rent trends last 30 days or last 60 days, or last 90 days. We can customize it. Normally we don't get it from brokers or sellers. Normally we'll get rent like this kind of rental from the brokers, like in Word document. Mostly we'll get in Excel format, and sometimes we might get a Word document or PDF format. We need to convert into Excel format for underwriting. So this is what we'll get from rent rolls. Then from T12, what do we get from T12? So mainly we'll get all the income and expenses. So from income point of view, there are different kinds of incomes, right? Other income, late fees, uh, some kind of stuff. And also we will get vacancy and loss to leases, how much we are losing because of LTL, how much we are losing because of vacancies, physical vacancies, and economic vacancies. And also expenses, like different expenses like general admin, contract services, utilities, repairs and maintenance, payrolls, insurance, real estate expenses, all this stuff we can see under T12. And also what else we can what else we can customize from T12. We can see how the income and expenses for last 1 month, 3 months, 6 months, and 12 months. We can customize all this stuff using T12. So any questions there? So basically we get this way, and then we'll input all this information into standard format here. So here we are entering number of units, square feet, and what is current average rent. Then in target rent, how much we can achieve this kind of rents. There are multiple ways we can achieve rents, like if current property is under rented in that sub-market, so organically we can achieve those kind of rents. And the second one is like by renovating these units, we can achieve this identify what is target rents. That is called forced appreciation by renovation, interiors or exteriors, or fixing some management issues. It's called forced appreciation. And other one naturally is called organic rent growth. Then we'll plug in like what is asking price. Then we'll plug in all the income, gross potential rent, vacancy, concessions, other income, all this stuff. Right, T12. Then also we'll plug in all these expenses from T12, like, advertising, contact services, insurance, general admin, or real estate taxes, more management fees. Also, we'll add, reserves. This is, standard is required from the lender. Normally, it's all the new properties like built after maybe 1980s, 1990, 250 per door. But if it is older before 1980s, normally we'll go with, $300 per unit. So this is based on T12, and on offer column L. So this will be our pro forma. I can say this is our pro forma based on our target rents. We'll be saying this much will be achieving it. So, and we'll be saying like year one, we can say 7% vacancy and 30% concession last lease, and this kind of the income will be achieving it. Also, we'll be saying we'll be operating this property in this kind of expenses. We can, we'll be projecting. There are some standard we can follow, like, it depends on market, and it depends on asset class, it depends on type of neighborhood and number of units. All these are factors we need to consider, when we are entering these expenses. And so normally, so you're going with, normal asking price will be getting from broker, and LTVs, this. So we can, we can check with, lender, and we can get the quote, how much LTVs we can get. So normally in the current market, 60 to 65 is the standard, and earlier it will be a little bit higher, but in the current market, 60, maybe sometimes 55 to 65, I can say, standard. And we'll be entering interest rate, anything above 6 million, there will be little bit interest rate will be a little bit lighter. Below 6 millions range, interest is a little bit higher. I can say above 6 millions is right now around 6% interest rates. There are some rates I got it. I will show you, in the presentation. And other one is cap rate, very, very important in this current market. Definitely cap rates are expanded compared to last year in 2021 compared to 2021 and 2022. Definitely it expanded, maybe depends on market, 50 bps to 100 bps, even more than that, depends on market, major tier 1 or tier 2 or tier 3 markets. So these are main things we need to plug in when you underwrite the deal. Okay. So any questions so far? So I will be moving back to presentation. Feel free to you can share your any thoughts and So Kim is asking how underwriting seller financial deals. So again, like seller financing dealers, so we need to get income and expenses, and also rent roll. We need to know all this information. Only difference is financing terms. What kind of, how much is financing, what are the terms, how much percentage is financing, 80% or 70%, and how much down payment we need to make, and what kind of interest rates, and what kind of terms, how many years interest only, those kind of terms we need to consider. Let's say, so Kim saying, okay, Kim, so 50%. So then we need to bring in 50%, and also we need to ask what kind of terms, like, interest rate, and also interest only period, and principal plus interest only, you know, those kind of stuff. Yeah. Is that answers your question, or you need anything else?
Can you model it on the underwriting? Yours?
Yes. Let me share you that, you know. But only thing is, if it is 50% LTV, we need to raise a lot of capital, right? So that is, you know, big thing in the current market. That is a trend, but you know, so here, like, you know, if it is down payment, that is, no, you need to put 50% down payment. Then here, you need to interest only. You need to get that terms, you know, that kind of conversation you have with, you know, that seller, what kind of interest rate only. So that you'll be entering here. Other thing is, like, here you need to enter interest only, interest rate, how much interest rate,
Okay.
and amortization, how many years. These things you need to enter. Yeah, only those stuff. Any questions?
Yeah, I see you have a 30-year amortization on this, and 36 months interest only. That's Fannie Freddie finance, correct?
Yeah. Yes. Yes.
How are you qualifying for Fannie Freddie if the rents are so low?
So again, like, you know, if rents are low, we'll get not that much percentage only, you know. So we'll get mainly we'll get loans based on, you know, current or T12 income and expenses. Okay. And also they will give, you know, DSCR 1.25. They will consider DSCR 1.25 stuff. And they will do their own underwriting, you know, based on T12 rent roll, you know. They'll come up with their own numbers, okay, based on T12 and this one. Okay, so if you want, I can share you one, you know, underwriting sheet from the lender. Give me 1 minute. I'll share you. Okay. Wait for 1 minute. So I'm pulling that data. So you will get to know a better idea. Loading. So Matt, was your offer based on actuals? Yeah, absolutely. Based on
Yeah, I
actuals.
was looking at the offers tab and I see the income looks like actuals, but the expenses are pro forma. Am I understanding that right?
Sorry, expense are coming. Yeah, so column L is like, you know, pro forma kind of stuff. Okay, so column C is like actuals. Column L is pro forma. These are the even income also coming from, you know, pro forma only. Yeah. So for lender code point of view, so once we share T12 and renters to lender will share, you know, their pro forma, they will come up with, how much loan they will give and what kind of cap rate, what kind of, IO they will give. See, if you see based on, they will come up with, income and expenses, other stuff. They will create their own underwriting.
Okay.
And their
Why do you
current,
have 30% on loss to lease and bad debt in the offer?
Sorry.
In the offer column 4, you have 30% for loss to lease and bad debt.
Okay, 1 second. I think I'm
Is there a
sharing.
reason you underwrote it so high?
1 second. Okay, I'm sharing wrong one. Okay. So you're talking about this one. Okay. So what we are saying here, down the line we'll be achieving 825. Current average is 510, but we are planning to achieve 825. But we are not going to achieve in year 1 itself. That's why you're putting like a lot of loss to lease. Okay. But you'll be achieving that, everything 825 in year 3 something, around year 3. That's why our loss to lease is, going down each year. Year 1 we are almost underwriting with 30% LTV. We are losing a lot of stuff. Year 2 we're decreasing that. So because renovating all units not possible in year 1 itself, right? It will take more time,
Yeah.
to renovate all the units. So that way slowly we are increasing that, and we'll be achieving that, year 3 or year 4. It depends on market. Yeah, depends on our business plan also. Does that answer your question?
It does, yes. What are the returns? You're looking at a 5-year hold on that one.
So,
am I reading that right?
Yeah, don't take it as serious. It's a just dummy one I'm sharing, but
Okay.
I will show you that, so since you asked that. So normally under summary section, so we'll get, so here we are validating, based on the inputs we are giving, how much returns we are getting, IRR, we can check IRR how much, AR how much, cash and cash how much, and under exit strategy, we are giving 5 years exit plan. Okay, this will be, we can see.
Okay.
Yeah, so this is I'm sharing only for demo purpose. It's not real one. Okay.
Okay.
Okay, let me share.
Thank you.
One for lending ones. Okay, so I think Kim, you asked about lending stuff, right? So once we share, T12 and this one to lenders, they will come up with their own, pro forma stuff. Okay, they will underwrite. They will come up with some overall income and loss to lease stuff, and this is the gross effective income. And also they will underwrite the expenses stuff, and they came up with 61 LTV for this one. And so this is what I got it.
Okay, so they calculate pro forma, but they're lending on T12 actually.
Yeah, T12 actuals. Yeah.
Okay.
So they follow. Maybe sometime they will add, T3 income and T12 expenses. Most of the cases they will go with T3 income and T12 expenses. Yeah, that is a standard. Even
interesting. Okay.
Yeah, even I underwrite like mostly, we'll go with T12. Initially we'll write with T12 income, T12 expenses, and also write with T3 income and T12 expenses. We'll make offers based on that. Okay, we'll see the trends, how much they're achieving last 3 months, and that our projections are realistic or not.
Okay.
Yeah, is that answers your question?
It does, yes.
Okay, sure. Okay, let's move back to presentation. So since time is essence, I will go over some important parameters we should consider in current market situations. So most of the cases in this current market, we are going with permanent agency loan So, and also is applicable for stabilized properties. If occupancy is above 85% only, we will get permanent agency loans. If occupancy is below 85 or below 90%, it's a bit challenging to get agency debt. And in current markets, bridge loan is very challenging. There are multiple reasons. Interest rates most of the cases above 8%. And also it's a bit challenging in current market conditions. Renovating units and repositioning property within short period like 18 months or 24 months is a little bit challenging to reposition and refinancing the properties. Those are the factors we should consider, for going with bridge loan. So these are some of the, interest rates course I got it from broker today. So it's today's rates. So current interest rates, these are current interest rates for different years, 5 years, 7 years, 10 years. And if you see Freddie Mac spreads and, Fannie Mae spreads, we need to add, index rates plus spread. That's how we'll get into rates, current rates. So for let's say 10 years, 65 LTV. So for Freddie Mac, they will see 1.35. Again, this DSCR is depends on market. If it's good markets like like Raleigh, Charlotte, Greensboro, it can be like 1.25. But if it is tertiary markets is they will restrict to 1.3. They will see 1.35, and interest rates are around 5.45 to 5.45. Yeah. And if LTV is low, you can see that rates also going down, spread also a little bit lower. So for 10 years, 7 years, and 5 years, Fannie rates are a little bit higher. And there are different options also available, life companies and some FHA loans, CMBS, all the stuff. And also for commercials, life companies and CMBS. And rent projections, how do you get rent projections? And also we need to validate all these rent projections. There are multiple ways we can get these rent projections. Apartments.com is a good source for, current market rents for that submarket or competitors for that, property. And also always we need to validate whatever the rent we are planning to achieve with, PM. It's a very important source. And different way we can achieve is like organic way and after renovation. So these are some, loan assumptions, LTVs in current market situations, low standard, direct loan 60 to 65 LTVs. If there is a loan assumption scenario, so LTV is coming around 45 to 55 based on my, underwriting or my, the scenarios where I came across. So in that scenario, we need to bring more capital to the, table. So we need to raise more capital. So, and capital reserves, definitely we need to add more capital reserves. That way, we can protect property in downtowns. Real estate taxes, definitely we need to consult tax assessor, and so we need to check when exactly it will be reassessed, how much it will be taxes. Some states it will like every 4 years they will reassess. Some states they will reassess every time they there is a transaction or a buying or selling.
Hello.
Yeah.
Hello.
Yeah.
Yeah.
Any question, Joel? Okay. And insurance, another important stuff. So in current markets, definitely insurance increase.
Så vi visste att det där.
I think many markets,
Men
definitely.
Andy?
Can you mute yourself, Joel?
Okay. When the Andys beton kommer.
Sure. Yeah, definitely insurance is very important, and insurance rates definitely increased most of the states, not only Florida and Texas. Even I do see in North Carolina also it increased almost definitely 25 to 50%, even more than that, So we need to, before submitting an LY, try to get code from insurance broker and plug in that numbers. DSCR we already covered. So, and this is another very, very important thing we should aware of, based on a recent ADIM reporting. They're projecting, they're forecasting some rent growth by metro. There are different factors they consider. So definitely rents are cooling down in most of the markets. Again, real estate is hyper local, so you need to, every market is different, so you need to validate with your PM or local market. You need to consider local market data also. The national level, they're forecasting average 2.5, and some states 3.7, 3%, 2.8. They're not projecting aggressive, like we saw like last 2 to 3 years, like it increased like 15%, 20%, 8% or 10% like that, but they're not project that in remaining next year or this year, next year. See, this is the rent growth. See, you can see like from February 2021 to May 2022, it increased like good growth. It went up to 18% something like that in some markets. Then slowly it's coming down. It's coming down. Again, rental by industry still there is like I can see around 4 to 5% rent growth. If you see for lifestyle, it's almost zero. There's not much rent growth here. So May 2023. So these are other factors we need to consider, and we need to plug in our underwriting. And other factor, very, very important factor we need to consider during the current market is like supply. So we're expecting a lot of supply, a lot of units, new units coming into market. So overall national level, so we're expecting 430K units coming into market, and we have some breakdown by market. So if a lot of units are coming into your markets, so we can expect some cool down, from rent projection point of view. Again, so all depends on class A, class B, class C also. Mostly all new units impact. Maybe mostly impact class A property, class A units. There will be light impact on class B and class C units. And also transaction volume, price per unit also. 2021 is almost peak. Overall national level is around 220K per door. In 2020 it came down maybe it decreased maybe 10%. In 2023 is coming down a little bit lower, maybe it's down by maybe 5%, 5 to 10% decrease. Yeah. So these things also we need to aware of, So yeah. Any questions, anyone?
Yes, back on slide 21.
21, okay. Yes.
So on the last column, it's UC as of June 23rd.
Yeah, 23.
Right.
Yeah.
What does UC mean?
UC means, yeah, I need to check that. I think as per my knowledge is as of this one.
Right, June 2023 this year, but
yeah,
I don't know the meaning of UC.
Until this time, overall, new units, yeah.
Okay.
I will check and I will get back to you on this one. It's a good
Okay,
question.
thank
Yeah.
you.
Yeah. Yeah. Any other questions? So we need to consider all these factors and plug into our underwriting, and if deal makes sense with overall returns like 5 to 8 or 5 to 10, whatever your criteria. If it meets your criteria, then only we need to submit LOI. So I just open it for any open questions, anything.
One question, you
Yeah.
know, my hesitation in turning in an LOI is that, you know, like if it is in best and final, and then, you know, like if it is awarded, you know, can I actually follow through? And so what do you think?
Can you come again? Your scenario?
Sure. So I've not been turning in an LOI
Yeah.
because if, you know, like if it's accepted, then I don't have the confidence to close the deal. So does this just go back to teams to like have a loan guarantor, risk capital GP?
Yeah. So yeah, it's not good practice, but you know, if you are not confident, if you think, you know, you cannot execute the business plan, you cannot achieve, you know, the returns, it's okay to, you know, cancel, and you know, that's fine, that's totally fine, but it will not give good, you know, credibility to, you know, broker, you know, or team, you know, that means you're not doing your research upfront, or like you're not doing your work, you know, upfront. But it's okay, you know, it's okay to withdraw, you know, offer if it makes sense, if it is the right decision for you and your team and your, you know, investors.
Okay.
Yeah,
Thank
that's
you.
totally fine. Yeah. Any other questions? And also I'm, you know, I'm also helping or supporting if anyone looking for, you know, coaching or any underwriting support, anything, you know, feel free to reach out me. I'm also starting that, you know. And if no questions, thank you very much, appreciate it, and feel free to reach out me if you need any questions or if you need any support. And
Thank
thank
you.
you very much. Thank you very much, everyone. Thank you.